Test. This is an overview of partnership taxation. So when forming a partnership, typically a partner does not recognize a gain or loss on the formation of a partnership. Outside basis is the basis of the partnership interest in the hands of the partner. So if I was a partner, my outside basis would be my basis. Inside basis is the partner's share of the individual assets in the partnership. Inside basis usually equals outside basis. Basis in and basis out. The beginning basis to the partnership is usually the basis of contributed assets. Step into the shoes. The basis of the assets in the hands of the partnership is the same as the basis of the hands of the contributing partner. So if I'm contributing an asset, then whatever my basis is, when I contribute it to the partnership, that will be the basis of the asset inside the partnership. Holding periods. So when forming a partnership, the general rule is that the holding period of the partnership interest includes the holding period when Section 1231 or capital assets are contributed. So if I bought a building in 1990 and I'm going to contribute it to the partnership, then the holding period would be 1990 for the partnership. Even though I contributed it today when we formed the partnership, they take the partner's holding period. Contribution of ordinary assets, the holding period begins on the date of the contribution. So if I'm contributing inventory, for example, that begins on the date of contribution. Whereas a building or equipment or any capital asset that you contribute will take the partner's holding period. We'll do more of this. Contributions of services. So if I contribute services to join a partnership, that is different than if I were to contribute an asset of some sort, a building, machinery, equipment, something like that. So a partner providing services in exchange for the partnership interest must recognize ordinary income. So if I'm going to join a partnership and my contribution to the partnership for my share is prepping all the financials and filing all the tax documents for the partnership, then I must recognize ordinary income to the extent of the fair market value of my partnership interest. Also, if a partnership assumes liabilities from that, any release of the liability by a contributing partner is treated as money distribution to the partner, which reduces the basis. Go back to my example of the building that was from 1990. If I contributed that and it had a mortgage on it, and the partnership took over the mortgage, and I didn't have to pay on that, then technically this would reduce my basis. So let's check it out. Generally, a partner does not recognize a gain or on the formation of a partner. True or false? True. Typically, the basis of assets contributed to the partnership is the same in the hands of the partnership as it was in the hands of the contributing partner. True. If two taxpayers form a partnership and each has a 50% interest, each partnership's outside basis must be equal. False. It may not be equal because I may get a 50% ownership, but I may be reducing liabilities, or I may have contributed outside services, or there may be something different. So it's not always the same. A partner does not have to recognize a gain on the receipt of partnership interest in the exchange of services. False. They have to recognize this as ordinary income. A partner who assumes an increased portion of the partnership debt is treated as making a cash contribution for his or her basis in the partnership. That's true. So if I'm responsible for more debt of the partnership, then that's like a contribution. Okay, so when we're talking about partnership, the very first thing, besides first we figure out basis, then the partnership's going to start earning money. So ordinary income or losses. This is sales, revenue from services, ordinary and necessary expenses. No items are included in ordinary income or losses that can be treated differently at the partner level. These are called separately stated items. So if I am going to provide Continuing services, accounting services. Partners can't take salaries from the partnership. So if I'm going to provide continuing services, I'm going to potentially set up a guaranteed payment. These are payments made to the partner that are calculated without regard to the partnership income. So let's say they're going to pay me $1,000 a month to do accounting for the partnership. And I'm going to keep all the records for income and everything. If that's the case and they're going to pay me $1,000 and it has nothing to do whether we make money or lose money, this would be considered a guaranteed payment. Partnerships follow the same rules as a sole proprietor for depreciation. All Section 179 item expenses must be stated separately because they'll be taken at the partner level. Partner health premium. Partners cannot exclude from income the health insurance premiums paid by the partnership. Premiums are treated as guaranteed payments. So if the partners are collecting health insurance from here, those payments are treated as guaranteed payments to the partner. A partnership can deduct which of the following in determining an ordinary income or loss? All ordinary and necessary expenses, guaranteed payments, depreciation, all of the above. The answer is all of the above. Absolutely ordinary and necessary expenses, depreciation, and the guaranteed payments. What tax form would a partnership be required to file each year? A 1120, a 1040, a 1065, 1120S. This is for corporations. This is for individuals, Schedule C. 1065 is for partnerships, and 1120S is for S-corps. Answer is C. A payment made to the partner that must be calculated without regard to income is a partner salary, partner withdrawal, a loan, or a guaranteed payment. This would be a guaranteed payment. General rule. All income expenses are treated items of a partnership that may be treated differently at the end of the level. At the partner level must be stated separately. See Table 14-1 in the text. I'm going to get a copy of 14-1 up here. Okay, so this is a copy of the table for 14-1. So, things that are included in ordinary items on a 1065. Gross profit. Ordinary income from Form 4797. Salary and wages to not partners. So we can deduct salary and wages to people that are not partners. For partners, they would be considered guaranteed payments. Repairs and maintenance, bad debt, rent, taxes and license, interest, depreciation, retirement plans, so if we have employees, employee benefits, and other ordinary and necessary expenses. The separately stated items. Net income from rental real estate. So if the partnership has rental real estate, they have to state this separately. Net income from other rentals, interest income, guaranteed payments, dividends, royalty income, capital gains or losses, Section 1231 gains or losses, charitable contributions, Section 179 expense, tax credit, and AMT adjustments and preferences. We'll get more into this, but this is the list of ordinary and separately stated items, general list. Like they said, the most common separately stated items are interest and dividends, capital gains and losses, rental income, and Section 179. All of the separately stated items must be reported on a Schedule K-1, which reports the share of ordinary and separately stated items for each partner. Line numbers on the K-1 respond to the Schedule K on the Form 1065, and each partner will get a K-1. Self-employment income. Since a partner is not an employee of the partnership, the income from the partnership is considered self-employment income. So, to calculate self-employment income, you take the ordinary income from the Schedule K-1 plus any guaranteed payments from the Schedule K-1 line 4. We'll go over a form. Less any capital gain included in the ordinary income. Less any Section 179 on the K-1, line 12. Why are items such as rental income, loss, capital gains and loss, and charitable contributions that flow through to a partnership treated as separately stated? Reality is that all income and expenses items on the partnership that may be treated differently at a partner level. So, for example, capital gains and losses will be taxed in a different spot for there's different individual rates. Rental income as well will be taxed in a different spot. Sorry. Why is income from a partnership treated as self-employment income? Because a partner is not an employee of a partnership. The income received by the partner from the partnership has no Social Security or Medicare tax withheld by the partnership, and therefore they must be taxed for self-employment income. Okay, so here is a calculation, and I also put a copy of this on Moodle, of how you calculate each partner's basis, and we'll do problems in a separate video. Basis of the property contributed, plus fair market value of any services rendered, or cost if partnership interest was purchased, plus any cash or property contributed after formation, plus any share of the partnership's ordinary income, plus the share of separately stated items that are income or gains, plus the partnership's liabilities, less any basis of cash or property distributed, but cannot go below zero, less the share of the partnership's loss, but not below zero, less a share of separately stated loss and expense items, less the partnership's release of liability. So if I contributed something and they release the liability. And that's how we get our basis in the partnership. A partner must use basis to determine the gain or loss on the sale of a partnership interest and whether losses are deductible. True or false? True. A partner's basis is not increased by his or her share of tax-exempt items. False. Actually, tax-exempt items, since they're not able to be deducted, it would change the basis instead, because otherwise you'd be taxed on this item, which is tax-exempt. In the calculation of basis, the order of basis adjustments is not important. That is false, actually. You need to follow that order because it's important to calculating. A partner's basis is never increased by his or her share of recourse liabilities. Recourse means that they can seek recourse, or they can seek payment from the partner. That's false. If the partner is responsible for the liabilities, then it does have an effect on the basis. Now we're talking about learning objective number 5, which is understanding partnership distributions. General rule: a partner recognizes no gain or loss on a non-liquidating distribution. A gain is recognized only when only money or marketable securities are distributed in excess of basis, or current distribution triggers a pre-contribution gain. A pre-contribution gain occurs when a partner contributes an appreciated property to the partnership. Within 7 years, the partnership distributes the same property to another partner. Basis of distributed property: typically the partner steps into the shoes of the partnership. Which of the following concerning recognition of gain or distribution from a partner? A gain is recognized if the partner receives property with a basis greater than his or her property interest. A gain is recognized if the partner receives cash in excess of his or her basis. The partner never recognizes a gain on a distribution, or the partner always. The answer is actually B. It's recognized if the partner receives cash in excess of their basis. That would be a gain. Nelson has a partnership basis of $12,000. He receives a partnership distribution of furniture with a basis of $16,000, fair market value of $10,000. The basis in the furniture after the distribution. What is Nelson's basis in the furniture after the partnership distribution? The fair market, his basis, or the $16,000 partnership basis, or none of the above? The answer is B. Nelson's partnership basis becomes the basis in the furniture. Assume the same fact, however, Nelson receives a cash distribution of $4,000 with the property. The basis in with the furniture. The basis in the furniture after the distribution is 8,000, 10,000, 12,000, or 16. The answer is 8. The basis in the furniture would be reduced by whatever the cash payment is. So 12,000 minus 4,000. If you were to dispose or liquidate a partnership interest, the rules are similar to current distributions. A distribution of money in excess of the basis would cause a capital gain. A loss can be recognized when the amount received in a liquidation is less than the partner's outside basis and only money, receivables, and/or inventory are received. If you sell your partnership interest, it's treated as a sale of a capital asset. If the partnership has a substantially appreciated inventory or accounts receivable, some of the gain could be considered ordinary instead of capital gain. Individual partners would report the sale of this on a Form 1040 Schedule D, which is capital gains. Shelley has a basis in the partnership interest of $30,000. She receives the following assets in a complete liquidation of the partnership: cash, inventory, equipment, land. What is Shelley's recognized gain? What is Shelley's basis in each of the distributed items? Okay, so Shelley's gain would be 0. She did not receive cash in excess of her basis. Shelley's basis in the assets would be as follows. The cash obviously is $9,000, so that's cash. Inventory, equipment. So after the cash and the inventory, that's $15,000. She has $15,000 of basis left times the $8,000 divided by 20. Equipment. Her basis would be $9,000. So I'm actually going to walk through these calculations of liquidations and basis in Excel in a separate video.